Hello, everyone, and welcome to the NASDAQ Dorsey Wright podcast for this Monday, February 22nd. My name is Will Gibson, and I'm joined by Sara this week. And we're coming in today, Sara, with a relatively muted, I'll say, broad equity market performance. S&P 500 posting small intraday losses along with the NASDAQ composite. Dow Jones slightly up on the day as we're seeing some of those more economically sensitive areas improving a bit more and showing some strength. Think your leisures, cruise lines, some airlines, things of that sort. But also noteworthy today, although it is muted movement on the surface, there is some interesting dynamics going on beneath. One of them being you're having a notable disparity between your value and growth areas of the market. And this kind of goes in tandem with last week, we saw a pretty big disparity between small caps, large caps, and we've had this really to start this year and a number of times at the end of 2020. So nothing too out of the ordinary, but a bit more of the same on that front. One other just kind of random thing that I wanted to mention before we get into the meat of our conversation today, looking across the market, we're seeing some things change, of course, and one of them is some relative strength signals within the industrial sector, particularly machinery and tools. It's been a bright spot in that sector. And Caterpillar actually returned to a relative strength buy signal versus the market for the first time in like over 9 years. So that's an interesting point to note. Although a lot of the strength in that sector has been smaller sizes, Caterpillar, one of the bigger holdings in the industrial select sector, actually did demonstrating a lot of relative price strength to get back to a buy signal. So that was something to note. But more so in line with what we're talking about today. We've talked a lot about small caps, whether it be through our reports, whether it be through our media, and us, along with many others, have certainly noted the outperformance and just the overall strength that we've seen from that space. But maybe at the same time, we're talking about small caps, which means we're not talking about large caps, which were a huge story in 2020 that really held the market together for a lot of the year. And Sara, maybe now we can shed a little bit of light on not just talking about small caps, but maybe let's look at large caps and maybe why that hasn't been the headline, if you will, lately.
Yeah, sure. Thanks, Will. So looking at your screen here, we have the size and style breakdown, the history for that breakdown within Dolly, which you can navigate to by clicking on asset allocation, Dolly, and then history. And then all you have to do is change your view by to domestic equity, size and style. And what this is doing is it's breaking down our various size and style boxes that we track here. And we're looking at the signal history. This is weekly going back to late November. But here, what caught my eye today is just even going back to the beginning of the year. So we'll use that 1/1/2021 line. Just the change that we've seen in signals from various asset classes, but also the change we haven't seen, particularly in large cap growth. So small cap growth, we've seen that size and style box gain about 11 signals. We've seen mid cap growth gain or lose about 12. Small cap blend has gained 30. And then we see the large cap growth, it's held steady at 113 since January 13th, basically. Even large cap blend, we've seen lose 19 signals. So we're seeing some shifts there, between the other asset classes, or the other size and style boxes, excuse me. But large cap growth, we've seen just maintain that same signal count, which I find to be relatively fascinating here. Another view that we can see this kind of holding pattern here in those large cap growth names is going to be on the chart of Amazon. Amazon is just a great example of just visually, you can see that back and forth action where we've been basically range bound between the 35.20 level and as low as 28.80, but just some back and forth action. We have given 4 consecutive buy signals, which is a positive thing. Today, we have pulled back to the middle of the 10-week trading band. We already were at 0%, so we are right there in the middle of that trading band. Another interesting thing here is just Amazon has maintained its positive trend that it's held since January of 2015. So over 6 years of this positive trend. And just over the last few months, we've tested it multiple times. It has held, telling us that the general price of this large cap name is moving higher. We've just seen it kind of stall out and move sideways. So haven't seen any sort of technical breakdown, just seeing kind of a stalling, if you will, within these large cap names. And again, Amazon is a great example. Another chart that we can look at for the same kind of just perspective is going to be the chart of the QQQ, so the Invesco QQQ Trust. We have seen the Qs, print multiple buy signals. The Qs actually sit at all-time highs right now at 335. So overall, technically speaking, from an absolute perspective, this is a beautiful chart. We just have not seen these mega cap names and these large cap names be able to kind of keep pace with their large or their mid and small counterparts. And even just looking at pure performance here, so QQQ, which is the top 100 non-financial names of the NASDAQ composite, is up about 5.5% so far this year. But if we look at QQQJ, which is kind of that junior QQQ, which is looking at the next 100 largest names on the NASDAQ composite, that particular fund is up a little over almost 12%. So just almost double. Again, that QQQJ also is sitting at all-time highs with consecutive buy signals. So we haven't seen any sort of any deterioration in terms of absolute performance on either, but in terms of the QQQ, there's no reason here to exit your position, if you will. We're still bullish here. There is still a reason to overweight large caps in your portfolio. We've just seen a stalling out, if you will.
Yeah, Sarah, I think that's good perspective, and something I was thinking about while you were talking is that there's definitely a lot more engagement with the markets. It seems like now, whether you look through brokerage reports of number of logins or account creations, or let alone social media, you'll certainly hear it there. And with that, maybe a lot of people want to see things that are moving, if that's a proper way to categorize it, or things that are plotting action, things that are maybe a bit more excitement, if you will. And like what you were saying, just large caps, generally speaking, haven't been that place like they were with a bulk of 2020. This year, that just hasn't been as much the case, where it's much more been with the smaller sizes, even some commodity groups with a lot more of the flair. And a different way that we can maybe look at this from an even bigger perspective. So apart from just looking at, these major indices that are still sitting at all-time highs, just not appreciating as much as some of the smaller sizes. Something else that I think is really helpful is to look at some previous historic market runs and try to size up where we are now, just to get a feel for it. So what I have pulled up here is a normalized line graph. So starting at a hypothetical growth of $100, say that we picked the bottom in 82, 2009, and 2020, and have stayed fully invested since then. Your x-axis here is number of days, pretty much trading days since the bottom. And the real point to take away here is the blue line, and note its presence above the other two historic market rallies. So 2020 sell-off right now, going into 2021, of course, is still well outpacing those other two historic market return periods. So right now, I think we could say that it wouldn't be too out of the ordinary, or even it could be healthy to see maybe some lateral movement, a bit of a breather from a more metaphorical perspective, or even a bit of a pullback to maybe get more in line with something historically. Not to say that history always repeats itself, certainly not the case, nor does it need to, but looking at, again, historic market rallies, 82, 2009, picking two there, this was the time that they traded sideways for a little bit, consolidated. You had a lot of kind of back and forth weeks as we're having now, and by and large was healthy. They went on to produce stronger returns in the years to come. But I do think this is helpful to see that, the velocity of the sell-off in 2020, that was certainly special. Velocity of the rebound, also very unique. But by and large, we're still outpacing those. So a lot of strength and even room to work with still. Pullbacks probably still keeping us above that. And just some other perspective that I was talking earlier about today that could be helpful. Since the March bottom in 2020, so March 23rd, if you were to pick that bottom, the S&P 500 is up over 70% since March 23rd. So we're not even back to a year after that March 23rd sell-off. It's up over 70%, up 4% this year, which we tend to slouch off now as it's not double-digit gains, but that's still a decent return 2 months into the year. NASDAQ Composite up 102% since the March bottom of last year, up almost 8% this year. And then the Russell 2000 total return, kind of small cap area, is up almost 130% since March 23 of 2020. And that has been the story, as we said, kind of the flare up almost 15% this year. So a bit of a pullback, a bit of a breather, a bit of a lateral movement would really be seen as healthy. I mean, after a 70%, 102%, or even 130% run, giving back maybe 5-10% would not be the worst thing in the world. And even from a historical perspective, we would probably stay above the rate at which we've been moving. So I did just want to mention that to maybe add some perspective and think through some of these recent pullbacks, some of these weeks that have gone flat, if you will. Recency bias, people get accustomed to seeing their portfolio grow or certain types of returns. So keeping those in check, I think, could be healthy. But lastly here, on a different topic from what Sara and I were talking about today, but related in one way, is a recent report that we put out looking at sector timing or sector rotation or different ways that you could phrase it compared to just a buy and hold S&P 500. And what we have here, unfortunately, I can't fit it on my entire screen if you're following here on YouTube. But if you were to just buy and hold the S&P 500 from 93 until, through about end of last week-ish in 2021, or excuse me, through 2020, you'd be up, to $150,000, starting with $10,000 with an average annualized return of just over 10%. However, if you were only invested in the market when it was up for the month, so you only participated in months when the market posted positive results, again, starting with $10,000, you would be over to 11 million now. But point being, annualized return up over 28%. If you were fortuitous enough or perfect timing enough to pick the best performing sector every year. So you put 100% of your money into the sector that was going to be the best performing, and you did that every single year, you would have generated an average annualized return of over 31%. Now, if you were very unfortunate and did the exact opposite, meaning you bought into the worst performing sector, 100% of your portfolio every single year, you would be on average annualized return be realizing a 10% loss. So the big picture here is that to have a system and to have a process to orient you towards high performing sectors or simply overweight sectors that are demonstrating strength empirically helps performance results and by and large can outperform or outpace just buying and holding broad market passive benchmarks. And the other side of the coin, certainly also the case, where it's not only important to overweight and pick winning sectors, but also to avoid and underweight some of those lagging sectors that can really hurt portfolio returns for the long run. So bit of a hodgepodge commentary there, but hopefully some of that can be useful. I will say that if you missed this report or if you missed some of our other reports as of late, we've added a new feature on the platform along others, but one that I did want to highlight is this little widget in the bottom right. It's this blue XO logo with a notification banner, like a push notification you may see on your phone. And if you click on this, you can see recent research highlights that we put together. And this sector versus market timing study being one of them that I just talked about. If you wanted to see it in a lot more detail and not just here from a 30,000-foot view that I was talking about, you can go to this little pop-up in the bottom right and see things that we're featuring, if you will, and that we want you to be reading and want you to be up to speed on that we're putting out. Some others that you can see, again, if you're following along here online, are going to be inflation expectations. We put a piece together on that. Check a month strategy, looking for yield in the market, unorthodox way to go about that, as well as some other articles that we wanted to bring to your attention. So that's in that little pop-up. There's also some announcements, whether it be events coming up, upcoming webinars, or anything else that we want you to know about. This is a new little feature in the bottom right. So wanted to bring that to your attention. And other than that, Sarah, that's about all we had on the docket today. So I thank you for hopping on, or more or less thanks for having me on. And I thank you for everyone who's listening. And we look forward to talking to you later this week.